Hello guys, and welcome back to the channel again. After this long pause that I took, I am so sorry because I didn't post for the last week, but I came back with a strong video with the episode 11 of our series Trading for Beginners 2026. And our first advanced concept will be liquidity. So the title of today's episode is Liquidity Explained. So jumping directly into it, when we speak about liquidity, we usually mean money or funds. This in the common sense that we all have. But as traders, we mean by liquidity something else. The definition in trading of liquidity is where a large number of orders are likely sitting. So basically, limit orders, pending orders, market orders, longs, shorts, all those types of orders that we saw in the earlier videos. So the second part of this course will be where liquidity is found. Liquidity in trading or in charts or in markets is found usually above previous highs, below previous lows, above equal highs, below equal lows, or around obvious support and resistance zones. So basically, just where traders, retail traders usually put their orders, there is where liquidity is sitting. Now, as our third part of this course, we will discuss the types of liquidity that we have and that we're interested in through this graphic or this presentation of a chart that we draw for the last two courses or something. We keep the same example. So basically, I'm marking this high, this previous high as stated before, as the blue color, and this previous low in the red color. So why I am doing so? Because this high, we call it buy side liquidity, like this. So what we mean by that, we mean that people usually the stops, the shorters are putting their stops above this high, and the longers are putting their stop market orders above this high. So basically, when some traders want to long, they wait for this high to be taken out. So instead of waiting and taking it manually, they put a limit order or a stop order just above this high. For the longers, the same thing. For people who went long, for example, from here up to here, their stops are usually in this area. So basically, here, the orders of their stop is line, and the positions of the shorters, the sell positions and stop market positions are just right here. So basically, this one we call it sell side liquidity. So basically, these are the two types of liquidity that we have in the charts. We have the buy side liquidity and the sell side liquidity. Buy side liquidity is usually the liquidity that is in the highs, and sell side that is in the low. Now let's jump to the chart to see these examples in a real market example. So as we can see here, this is the gold chart. I will mark out some lines, and you can tell me which ones are the buy side liquidity and which ones are the sell side liquidity. So I'm marking 3 highs for the buy side. This is 1, this is 2, and this is 3. And for, let's make this another color, and this, and then for example just this, and then let's mark these ones with the blue color. So I guess it's obvious, very obvious, to differentiate buy side from sell side. From this example, you can see here, this is a high, and this one is a high, and this one is a high. So basically, limit orders, stop orders, and market orders are relying here of the orders of retail traders and of institutions, while the sell side orders are these ones. So what is the use of these points? The use of the BuySide and the SellSide liquidity is to mark them as targets or mark them as stop losses. We use them as stop losses too. We don't use them usually as targets. We use them as stop losses sometimes. And we pay attention to the reaction from these levels. So that's the importance of buy-side liquidity and sell-side liquidity. And that was all for this video. Just a quick, simple video to go back on track of posting in the channel. And if you didn't get something from this video, or you need something explained in the next videos, please don't forget to mention it in the comments. See you guys tomorrow.